Hello everyone and welcome to another real estate video. This is Javier Vidana, the real estate YouTube guy here in Phoenix, Arizona, helping you accomplish your home goals. In today's video, we are going to discuss, or rather rediscuss, FHA versus conventional loans. Now, yes, I do have a video on the topic, but recently I had someone call me and say, hey Javier, I want to work with you. I love your videos. My favorite one has been the FHA versus conventional one. So I watched that one. I really learned a lot. And then I looked up some more recent and more modern ones, and I got a little more information. And I said, huh? So on YouTube, if your video is more than 1 to 2 years old, it's considered old and outdated, even though the information is still kind of relevant. So listen, I'm going to make an updated video for 2020, 2021. Things have been kind of changing ever since the pandemic. And on top of that, I've, in the last, I'd say year, 2 years, met with the most amount of people I've ever met with in my life, and have explained this probably at this point hundreds, almost, I want to say 1,000 times. So because I've explained it so much, I feel like I have a more refined, if you will, approach of talking or defining it. So what we're gonna do is we're gonna get conventional, we're gonna get FHA, we're gonna combine them and talk about them and figure out which is the best option for you. Before I begin though, just a heads up, I'm not a lender, I'm not a mortgage professional, I am a real estate agent who has helped hundreds of people buy homes. So make sure to verify this information with your local lender when it's ready to buy a home, when it's time to buy a home. Got it? Cool? Okay, let's get going. So why am I talking about FHA and conventional? Well, traditionally for a first-time home buyer, this is the two programs that are commonly most used. And if you're wondering about down payment assistance and what's up with that, well, most down payment assistance programs are either FHA or conventional. The only difference is there's different layers on top of these loans, and because they include a government grant or some kind of second lien on the property. So either way, if you're thinking about going down payment assistance, it's still relevant to find out if you should go with an FHA or a conventional down payment assistance. When you're thinking FHA, I want you to think of Uncle Sam, right? There with his loving white beard and beautiful eyes looking at you and taking care of you. And for conventional, think about a room full of people in suits. FHA, it's Uncle Sam, it's the government. With a conventional, it's a room full of people in suits. So let's start off talking about FHA. So back in the day when houses were a lot cheaper, they would be worth $20,000, $30,000, $50,000. People would put good down payments to purchase their house. You know, the houses were so cheap that, you know, you could save in theory 50%, 20%, 40%. You would be able to save a lot of money towards it and pay it off relatively soon. If you don't believe me, look at your neighborhoods and look at houses what they used to be selling for 20, 30 years from now. You're going to be shocked. What has happened over time is houses have gotten more expensive. However, the living wages or the minimum wage has retained pretty low. Now, granted, it has gone up in the last decade, I would say, but still at $15 an hour or whatever it is right now, it's not enough to sustain the traditional normal house payment. So because houses are more expensive, clearly people cannot come up with 20, 40, 50% down of their houses anymore, or at least most people are not. So this is where FHA comes in, okay? So it provides the everyday man or woman the ability to buy a home without needing a giant down payment and having relatively low barrier of entry. So therefore, it promotes home ownership in this country, and people can realize their dreams of home ownership without having to, you know, kill themselves and waste, save so much of a down payment. Normally, the two basic things you need to qualify for FHA is you want a credit score. I think it ranges. So there's different investors with different companies. So some minimums might be different in different brokerages or banks or whatever, but it can be as low as 580 to like mid 600. I would say 640. However, in my experience, most lenders relatively take 600 as their minimum score. And with FHA, it doesn't matter if you're at a 600 or if you're at a 750 or you have a 900, okay? It's once you're in, you get the good stuff, baby. You don't have to worry about saving and getting your credit a lot higher, okay? As soon as you get in the program and you have enough qualifying credit, you're getting the same good low interest rate as someone who has a higher credit than you who's buying a house that with FHA at that moment. See what I'm saying? So this is a great product for someone who maybe is working on their credit still, or maybe is recovering their credit, or maybe just didn't make the right steps to build your credit. It's perfect. You don't have to be in the 700s, 800s. You can be as low in the 600s. The second thing is you need a down payment of at least 3.5%. You could have more. You could put more money towards it. However, putting more money towards it would just be to pay off the balance. So if you are planning on putting more money towards it, one thing you could consider is trying to pay off the mortgage insurance, which now we're going to talk about the third thing with FHA, which I would consider a con, is there is this thing called mortgage insurance. So mortgage insurance, to summarize it in layman terms, is banks were kind of nervous loaning these low down payment programs with minimum thresholds for credit and stuff like that. So mortgage insurance kind of gives them that safety net they need. If for some reason you decide to not pay your payment and it defaults and it forecloses, the mortgage insurance kicks in and the bank gets most of their money back. Fun fact, well, not fun, I guess, but a fact, if you ever see a HUD home for sale, HUD, HUD home, it's basically an FHA loan or someone who had an FHA loan where the mortgage insurance kicked in and now it's owned by HUD, which is FHA. I don't know if this is true. Javier, in the future editing, please verify if HUD and FHA are still the same entity, because that's what I remember it being. So in theory, with this mortgage insurance, if you're more high risk, they should have a higher monthly premium for the insurance, right? Just like a car. If you're gonna get car insurance, you're higher risk, you've had previous accidents, you're younger, they're gonna charge you a lot more. Well, with FHA, it's just like, once you're in, you get the great interest rate. Once you're in, you're still going to be judged the same as everyone else. You're going to get above average mortgage insurance. Now, it's not, I used to say it was super high. It's not super high, but could be better. Got it? So with FHA, as soon as you're in there, you're getting a kind of high, not so high mortgage insurance that you're paying per month on your monthly payment. And here's the kicker. You're paying it forever. You're considered high risk forever. Is it year 29 and you're about to pay off your freaking house? Too bad. According to FHA, you're still considered higher risk and you're paying mortgage insurance for those last 5 months. So for some people, it may feel like you're trapped because you're always paying this mortgage insurance number and it's higher, and it feels like FHA is automatically something you write off. But the truth is, sometimes your monthly payment still ends up being cheaper because the interest rate with FHA is amazing. It's always been the lowest, at least in my experience. So the low interest rate offsets the extra cost of the mortgage insurance, and your monthly payment still ends up pretty cheap. I feel, in my opinion, FHA is a solid product for a short-term situation. Now, short-term could mean 3 years for you, it could mean 5 years, it could mean 10 years. I don't know what short-term means to you, but it means that I'm not going to be in this house forever. My first 2 houses I had were FHA, and even though I could have gone at conventional, I took advantage of the lower rate. Let's talk about conventional now. So with conventional, I told you to think of a board meeting of just a bunch of people in suits, right? This is why. So conventional is a more traditional loan. Like if you go get a loan from your bank or a car loan, you're judged on your credit, depending on when, and that they're going to use your credit and your history, your income to figure out what your terms are going to be, right? That's what conventional is. It's not backed by the government or Uncle Sam. It's backed by private investors. So because they are more private and they're not government backed, you can have multiple conventional loans. With FHA, you can only have one at a time because it's meant for just not necessarily first time home buyers, but it's meant for someone to kind of jumpstart their home buying journey, right? So let's start off by talking about down payment. The biggest myth I get from conventional is that I need 20% down. And a lot of people just write it off just for that reason. True, you do get the best rate and the best everything package with 20% down, but the reality is you don't need 20% down to go conventional. Some people can get it as low as 3%, 5%, 10%, or 20%. Now, the way I understand it is you could in theory put 6, 7, 8, 9%. You can put 11, 12, 13, those middle numbers, they could be the number. However, I believe your interest rate, the way it fluctuates, it happens in sections. So if you're 3%, your interest rate's a little higher, 5%, it's a little lower, 10%, it's a little lower, 20% is lower. If you're like at 14 or 13%, it'll be basically the same rate as 10%. So that's why it's better to figure out what those numbers are and stick to the lowest one that'll give you the best rate. You don't put the extra 2% because just you think you're gonna get a better rate, right? So anyways, with conventional, it can be as low as 3 or 5%. 3% being lower than the FHA 3.5, 5 being higher than the FHA 3.5. Now, there's some loan situations where the 3% conventional loan is actually meant for only first-time buyers. I think 5% as well. So just make sure to confirm that with your lender. And if you're buying a second home, you have to make sure if it's a second home, you can put 10, or if it's an investment, you can put 20. So that's where I will leave your conversation to be up with your lender. So let's talk about the credit score now. So with the credit score, you could get a conventional loan as low as the mid 600s, but then you should ask yourself, should you? Here's why. Conventional is using your credit score to judge two things: what interest rate they give you and what mortgage insurance they give you. They can actually use your history to judge you and determine how high risk you are to determine what kind of mortgage insurance to give you. So let's say with FHA, on average, you're paying $100 to $200 in mortgage insurance. Well, you're going to get that same high mortgage insurance regardless of your credit score. Conventional, if you have a great credit score, you might get a mortgage insurance in the 50s or 60s. It's going to be really cheap. Your interest rate might be more expensive if your credit score is lower though. So if you're in the mid 600s, you might get a higher mortgage insurance than if you would have gone with FHA, and your interest rate will probably be a lot higher than if you would have gone with FHA. So even though FHA is getting you with that permanent mortgage insurance, your payment still might be a lot cheaper there. Does that make sense? So even though you can get it as low as the 600s, you probably want to be in the, I want to say 700s. I've seen the best kind of situation in the mid 700s, but I've seen some pretty good ones in 720, 730s. If you're wondering why I'm not giving you exact numbers anymore, is because it varies, guys. It really day by day, week by week, these things change. So I'm giving you a general range. Like I said, regarding the mortgage insurance, it's actually two things are different here. Not four, two things are different here. Like I said before, it's shoppable, so the lender can actually shop it around and get you a better number there. But on top of that, you have the potential of paying it off and get rid of it entirely. You could, in theory, put 20% down off the bat and get rid of it and just gut it. However, if you, let's say you put 10% or 5%, as you live in the home, two things are happening. Your value is going up and your loan amount is going down. Right? So once you get to the point where whatever your value is, if your loan is 80% of that, or I think it's 75, editor, please confirm, it's going up there. Once it's at that point, then you get rid of your mortgage insurance entirely. So for some people, this might take 10 years, 15 years, 5 years. But the point is, and the thing I drive with people is you're actively working towards something with conventional. You're working towards paying off that mortgage insurance. You're more incentivized to give a little higher payment so you can get your loan amount faster. You're more willing to go upgrade your cabinets because your value will go up. You're just like, it's like an active, like it's alive, it's alive. Whereas FHA, you're kind of like, even if you get a nice cheap payment, you're kind of just there. You're stagnant. So to finalize this video, let me go over my final thoughts about it. Like, obviously, there's much more integral things happening here. So when you get pre-qualified, the good news is your lender or loan officer will be able to pull up both scenarios for you. Loan officers love to just say this is the best one for you, go for it. But I'm a fan of options. Whenever you talk to your loan officer, have them give you both options. It doesn't matter if one is clearly the winner. You want to be informed, right? You want to see the difference, not only the difference of monthly payment. The people just get focused on the monthly payment all the time. Focus on the overall life of the loan. How much interest are you paying towards one over 30 years, and how much interest are you paying on this one? How does a mortgage situation work? Is that mortgage insurance permanent one? Is mortgage insurance going to end at one? Just get the whole picture for both scenarios. Anyways, guys, that's all the time we have for today. Thank you so much for watching. I really appreciate your time. If you're still watching, don't go yet. I want to let you know I have this ebook that I made and it's for sale right now, and it's really amazing. It has like 12, 13 worksheets where I help you get more prepared and educated for your home buying process. It is available on my site. Link is below. You can check it out. If you want to join the Home Goals community, that is also available on my website. I'm going to start making like weekly live videos specific just for them. I also like to give like little tips and strategies that are exclusive to that community. And lastly, if you're looking for a real estate agent in Phoenix, Arizona, I am your guy. My contact information is below. Any questions or anything you have, guys, I'd prefer you DM me through Instagram or Twitter. I love to send like video messages back to you guys. You can also leave a comment below. Let me know if you watch the whole video, because I always love seeing those messages. Thank you guys so much for your time. I appreciate you. Have a wonderful day. Thank you.